Let's do it, folks. Good morning, one and all. Welcome to The Street today, here from Post 35 on the floor of the New York Stock Exchange. That is, in fact, where we are. Today is Thursday, February 23rd. I'm JD Durkin. We are about an hour or so into the trading session. Markets are trading in the green. We got the NASDAQ up 0.6, the S&P 500 up 0.6, the Dow is up 0.4 at the moment as investors look for clues on the Fed's next move. Really trying to see, it's like Blue's Clues, basically. Remember the show Blue's Clues? But it's Jay Powell, and we're trying to figure out where they go from here. Following the release, of course, of the central bank's February meeting minutes, that we got those numbers yesterday. Investors also reacting to the latest data on jobless claims and fourth quarter GDP revisions, which we got a short time ago. We'll dive into all that and much more. Let's talk about what else is on tap for the show this morning. We will talk Fed. Surprise, we're going to talk about the Fed? Of course we will, because today ends in Y, as investors continue to parse through minutes from the February FOMC meeting. Plus, we will tell you what to expect from the central bank's preferred inflation gauge. Ah, yes, folks, it's almost PCE day. You excited? Are you as excited as we are? We'll get those numbers out tomorrow. And finally, we'll do an earnings roundup as names like Nvidia, eBay, and Moderna all report quarterly results. For more on these stories and so much more, let's now bring in our special guest on this Thursday. Sam Stovall is Chief Investment Strategist at CFRA. Sam, good morning. Thank you for being here.
Happy to be here.
So we always like to pay close attention to the minutes that we get on a day like yesterday. Obviously, we already knew what the result was, but what more did we learn from the information released at 2 o'clock yesterday?
Well, I'm not really sure we learned all that much more than what had been stated in the Powell press conference, as well as the statement that followed the February 1st conclusion. But I think it's just higher for longer. And as a result of that meeting and the comments by the Fed Chair Powell, as well as the employment picture, as well as retail sales, et cetera, our conclusion was that we're likely to see the Fed raise interest rates 3 more times, March, May, and June, before they hit the pause button, and that our terminal rate is estimated at 5.375. So it looks as if we're getting close to the end of the rate tightening cycle, but we did have to add a few more increases to our estimate.
Are you of the thinking that March, May, and June will feature 25 basis point rate hikes for each?
Yes, I am. And I think that the market is basically feeling that, we're getting close to the end. And the real question is, how long will they pause? Because historically, the Fed has taken 9 months from the end of the last rate hike to the beginning of the first rate cut. And historically, the market has done very well, rising an average of 13%, accompanied by positive returns for all sizes, styles, and sectors within the U.S. marketplace.
The minutes yesterday indicated, Sam, that ongoing rate hikes will be necessary. You said there a few members of the committee favor a 50 basis point rate hike. We talk a lot about people like Mester and James Bullard. They're not voting members, but there is some degree, perhaps, where they have influence over their colleagues. What's your sense of the possibility of 50 bips for March? Or is that kind of off the table as far as you're concerned?
Yeah, it's off the table as far as I'm concerned. I think what the street is expecting, about 70% probability that a 25 basis point hike is what we will see at the March meeting. And with GDP coming in now weaker than expected for the fourth quarter, our expectation was we'd see the 2.9 revised higher to 3.0, but it actually went the other way. I would tend to think that the Fed, realizing that it's aiming at a target that's over the horizon, they want to make sure that they don't overshoot, and as a result, throw us into a very deep recession. So I would tend to say that the GDP data today, as well as additional data we are likely to get, will give more reasons behind a 25 basis point hike.
The minutes also noted, Sam, that some members see a risk of recession as elevated. And so I'd now like to ask you what has become the new go-to question. Do you see a soft landing, a rough landing, or as some people are now offering, no landing at all? Where do you fall?
Well, our economists are saying no landing at all, essentially because we've been seeing an improvement not only in U.S. economic growth, but also global economic growth. I look to history, and obviously knowing that history is a great guide, but never gospel, I do point to the fact that the inflation numbers are as high as they have been. Anytime we've been above 6% on a core headline CPI basis, we have fallen into a recession and a bear market since the late 1940s. We've been looking at the yield curve, which last time it was this inverted was in 1981. So that too followed a recession. We look to year-on-year percent changes in leading economic indicators. That too is pointing to a recession. And then finally, Q4 of 2022, we are looking at a earnings decline and are expected to see additional decline in Q1 and Q2. So an earnings recession is traditionally associated with an economic recession. So I think those factors point to one, but my belief is that it's likely to be mild, not a repeat of the Great Recession.
If you had been in the room with Chairman Powell several weeks ago during his press conference, I wonder what would you have wanted to ask him? Obviously, keeping in mind that was before we got the scorching hot 517 figure, other retail sales data that really showed a very strong consumer, further data that demonstrated a very strong labor market. But at the time, I wonder what you would have liked to ask the chairman of the Federal Reserve had you had the opportunity to ask him a question.
Well, probably if I asked him one-on-one, because he'd more likely to give me an honest answer, it would be how much are you or the members influenced by the actions on Wall Street? If we were to see an earnings recession, is that something that is factored into your decision-making process? What about the move in the market itself, in a sense, trying to call the hand of the Fed by saying, if we're looking for a very sharp advance in January of 2023, what does that imply for the likelihood of a pause and then the beginning of a rate cut program? So, all of the other factors he has made very well known to investors as to what they are looking for. So I would basically be saying what other factors could end up influencing, and in particular, be corporate earnings.
Sam, before we pivot on and talk about other topics, I'm just curious, and I'd like to give you the opportunity to talk about anything else, central bank, Jay Powell, minutes related, that you think are important for our viewers to take away from this conversation that maybe you and I have not yet had the opportunity to directly address.
Well, I guess just the one last thing is that I think we've all been spoiled, if you will, by this very, very low interest rate environment for quite some time. We're nervous now with the 10-year yield being at about 3.95. But when I go back to 1953, when the Fed did start to report 10-year yields, we've been seeing an average that's closer to 5.5%. So when I think back to the first house I bought, et cetera, looking at other interest rates, et cetera, my feeling is we will get through this and that we are actually fairly fortunate to have the 10-year yield be as low as it is.
Absolutely. Okay, so thank you for that. The S&P is coming off a 4-day losing streak here. Do you expect reaction from yesterday's minutes to have any kind of impact on the market activity today? Granted, we are still in the green to some degree. I mean, listen, the S&P is back over 4,000. That has not been the case all week.
No, I think that the market responded the way it did yesterday, giving an implication that the Fed has not sounded any more hawkish than investors currently are assigning to them. And the real question is, I guess, what is likely to be happening going forward to the possibility of recession or lack thereof, and whether the October 12th low was the low for this bear market. I think certainly that bear markets need to be retested, so we'll likely at some point retest that 3,500 level, maybe not going all the way down there, but at least come down a bit, see elevated volatility, increased concern by investors. But if we end up maintaining that support, then I would tend to say that the January barometer has been correct. And usually a positive January following a down year has seen the market advance 92% of the time with an average gain in excess of 21%.
Yeah, we don't frequently see back-to-back losing years for that particular index, so that note about the kickoff rally that we had in January is well taken. I would like to ask you about weekly jobless claims. We've seen them fall here. They come in at 192 compared to 200,000 that were anticipated. What's happening with the labor market? What is your sense here, Sam?
Well, I think, that the labor market, we're seeing an opening once again of a lot of the service areas of the economy, restaurants, bars, in terms of cruise lines, things like that. So we're not necessarily seeing a big jump in the wage factor, which is good, but we are seeing an improvement in the jobs picture itself, and so that's the one factor that our economists are saying will likely be supporting the fact that we end up with either no recession or a mild recession. Of course, that also is a bit of a concern to the Fed because they want to make sure that they do strangle inflation. But I think that with most of the jobs being in the lower pay scale, that we're not likely to see that big of an impact from the increase in the job picture.
Let me ask you about fourth quarter revisions for GDP for last year as well. Faster than expected, 2.7%. I mean, if you look at last year's 4 quarters now over GDP, it's the tale of 2 years basically, right? You get the first 6 months, the first 2 quarters at negative, and then I don't know how many people saw the third and fourth quarter figures where they are for all the talk of, oh, well, we're clearly in a recession because we got back-to-back declines in GDP. Yeah, it's a little bit of a different story now, but give me your sense how we should read that figure, especially with the latest revisions here. It's a big number, and I mean for Powell, who's going for below trend growth, 2.7% is not below trend. Sam.
No, it's not. But I think, people point back to the first half of 2022, and they do look at those 2 quarters of GDP decline. They're reminded of Arthur Okun, the economic advisor to Presidents Kennedy and Johnson, who was the one that coined the term that 2 successive quarters of GDP decline make a recession. Well, actually not. It's the Business Cycle Dating Committee of the National Bureau of Economic Research who tells us whether we're in or out of recession. Unfortunately, on average, they tend to tell us that about 8 or 9 months after the fact. So it ends up being probably a better indicator of when to buy stocks than it is when to bail. But certainly seeing an improvement in economic growth, certainly not to the extent that investors would want. Our forecast is for a 1.7% gain in real GDP for all of 2023. And then we move back above the 2% level in 2024. I think the Fed is being able to manage at least a soft landing for the economy.
So Sam, you're a fan of history. I could tell that about you. So let's do that because I'm glad you mentioned the NBER because I think people forget the perspective of what it looked like during the '08 downturn, okay? The National Bureau of Economic Research, the dating committee that you just referenced there, said we went into a recession in December 2007. But they did not make that declaration until December of 2008. So that lag was 12 months, okay? And then in terms of its definition, if you will, or neatly defining when we climbed out of a recession, they made that claim that we got out of the recession in June of 2009, but they didn't say that until September of 2010. So that's more than a year for them to look at data and say, okay, we actually climbed out of the recession about 15 months ago. So give me your sense about what, because we don't hear a lot about the dating committee right now, but I wonder if at some point here in 2023 we will, and it will suddenly be everywhere. If this group of economists and university professors get together and say, hey, actually, yes, we did hit a recession, or there are these concerns with backward-looking data, give me your sense on what that could look like. And is it your expectation that, as some suspect, we're not really talking about this, the NBER right now, but we very, very well may, in very real terms, if they do decide, yeah, actually, we did, and we hit it a long time ago.
Absolutely. Well, to their credit, they did respond very quickly to the recession of 2020, also indicating that it was a fairly quick recession. The stock market itself ended up falling 33% in the swiftest time frame going back to any bear market on record. And then it only took us 5 months to get back to break even following that bear market decline in 2020. NBER was very quick in telling us about the recession when we entered, when we got out. So yeah, until we hear from that business cycle dating committee, most people will not be saying anything about the recession. And I guess the question then is, how quickly will they tell us that we're then out of the recession? So it's just really more a formality, if you will. I think most people are of the mindset that we are in a recessionary type of environment. Even Fed Chair Powell said that we are in a disinflationary environment, which is what he wants, but it's going to take until 2024, in my opinion, before the core PCE comes down close to where their target rate of 2% is.
And some officials have said it won't be till 2025 until we actually hit 2%. Since you mentioned PCE, we will get the Fed's preferred inflation gauge tomorrow. You know, the most interesting thing to me is the one data point that Powell keeps talking about, core PCE, or that kind of super core inflation number specifically on services. So strip away the volatile elements of food, take out energy, take out shelter and housing. And he's like, man, that number is really stubborn. What are you anticipating specifically with an eye, Sam, on this one stubborn metric that we know Chairman Powell just keeps talking about over and over again?
Well, services really represent the bulk of the U.S. economy. I mean, manufacturing used to be a very important component, but now that represents less than 10% of GDP. When we look to the services portion, then obviously that is very important because it's also a question about sustainability. In terms of, extracting food, extracting energy, a lot of times people say, gee, doesn't the Fed assume that I have to eat, I have to heat my home, drive my car, etc.? Well, the reason that they take that out is because they have no control over the weather. And whatever commodity is in short supply one year will probably be oversupplied in the year after. And in terms of energy, they don't want to, in a sense, be handcuffed by the actions of OPEC, Russia, etc., in order to turn on and off the spigot in order to wreak havoc with our monetary policy. So, the question is, we are expecting to see a continued downward stair step in terms of PCE, in terms of core PCE, and that going along with that, we would expect to see a decline in that services component as well.
Yeah, absolutely. Well, that would be welcome news for many who are watching, and we'll see what the figures have to say. We get them tomorrow, and of course, then we all get to sit there and wax on about what we think the Fed will do at their March meeting. While I still have you, let's talk a few more generic, more generalized questions with regards to investing. People are wondering, given where the market is right now, people want to buy the dip. People want to know where the buying opportunity is. And obviously, we've had a lot of volatility even in the month of February. What's your answer to that question? Do you view now as a good buying opportunity, Sam?
Yes. Well, first off, I'm more of a long-term investor. CFRA equity analysts, when they make buy, hold, and sell recommendations, it's for the coming 12-month period. So I'm not going to be making sector recommendations based on the coming week or month. But what I do, as I showed before, is I'm a student of history, and there have only been 2 times going back to World War II that we have had more than 1 year in a decline mode. Historically, these 21 decline years were then followed by an advance in the S&P 500, on average 14.2% versus the more normal 8.9% advance. And the batting average, the frequency with which the market has risen, was above 80% following down years versus a shade above 70% for all years. What I've also found is that following a down year, investors tend to rotate from first to worst. What I mean by that is those groups that held up the best during the down year, traditionally consumer staples, healthcare, utilities, end up being underperformers in the year after. And if you actually bought the worst performing sectors from that down year, instead of getting, and I'm going back now to 1990 because that's as far back as S&P as sector level data, instead of getting a 9.3% return for the S&P, you ended up with 11.3 for those worst performers in the prior year in now that subsequent year. So traditionally, investors are looking for opportunities, and for those groups that were beaten up the most in a down year, they tend to outperform in the following year.
For anyone who might not be quite yet ready for individual stocks, Sam, are there any ETFs that you would recommend as a safer play?
Yeah, actually, I wrote a book a few years back called The 7 Rules of Wall Street, which are rules-based investment strategies. So as a way for investors to extract their emotions from the equation by basically saying, look, I can beat the market if I engage in either momentum, seasonality, or correlation. And looking at a correlation perspective, you can offset the volatility of technology by having a 50% exposure to consumer staples. Going back to 1990, even though tech was the best performing sector of all 11, you paid for it in an elevated volatility perspective. But if a 50-50 portfolio of tech and staples rebalanced annually, you got a return that was actually better than tech, but ended up being substantially lower in terms of volatility, and your return for risk ratio was better than that for the market itself. So by having 1 foot defensively positioned, 1 foot cyclically positioned, you do end up being able to sleep well at night and brag about it the next day.
Well, that sounds good for everyone. Finally, what are some of your tried and true investing tips that you are carrying into the new year?
Well, it's basically don't let your emotions become your portfolio's worst enemy. Realize that there is a cycle to the stock market. Right now, we are in the best 3-quarter period of the entire 16-quarter presidential cycle. The quarter we're in right now has the highest average gain of close to 7% and a highest batting average close to a 90% advance. Last quarter was the second best, and the one we're heading toward is the third best. So basically saying, like whitewater rafting, sometimes you just let the market take you where it wants to go, but realize that you are a long-term oriented investor. And if you happen to be an income-oriented investor, think like a landlord. Think that the dividend is like your rental payment. Make sure that your tenant, if you will, has a good track record of paying the rent, and even better, what they don't squawk when that rent gets raised.
Are you a whitewater rafting fan, Sam?
No, not too much. I leave those kind of excitements to other people.
Fair enough, but it's a great comparison, and I had to ask the question. You're a fantastic guest, and I hope we could do this again. Thank you for the much-needed perspective and context. Sam Stovall is Chief Investment Strategist at CFRA. Sam, enjoy your Friday Eve. Thank you for being here.
My pleasure. Thanks for having me.
You got it. All right, folks, coming up here on the broadcast, we will bring you the latest headlines on everything you need to know. But first, TheStreet's Catherine Ross sat down with technical analyst Jay Woods to discuss current market conditions. Take a look.
So stocks right now are coming off of being in the green for a full month, and now we're starting to see that rally kind of dissipate. Is that the end of a bear market rally, in your opinion?
Yeah, that's the big question down here. I mean, we had such a rough 2022, left a bad taste in everyone's mouth, and now we had this massive and quick rotation into all the beaten down names. And you know, from as a technician, we got to some key technical levels and we cleared them. So there are some really good signs that this is more than a bear market rally, that it is a sustainable rally. Does it keep going much higher? I don't think so, but you know, chopping and going sideways for a while after the year we just had, not a bad start to the year, but it's not smooth sailing all the way through. We've got a lot of things to digest, but the start was fantastic. The speed at which it happened, it caught a lot of people off guard, and then technically, we never retested those October lows. We just broke above December highs. So we're in a nice little trading range, and we're going to watch Fed announcements, Fed talk, which we see all the time, to see which way we go. And then earnings season, Q1 so far has been good, so it's been okay.
Technically, what levels are you watching in the market?
Well, you know, the 200-day moving average has been that line in the sand. In the S&P 500, it's about 3950, just under 4,000 now. And, you know, what we want to just see are a consistent level where we're making higher lows. And we've seen that. You know, it doesn't just go to new highs like that, although the Dow, the transports, two big, you know, leading indicators here are on the verge of 52-week highs. So there are a lot of positive things, but I don't think people can expect to see what we saw in January continue. What we want to see is more of a broadening of the market, and not just the laggards lead, but, you know, 9, 10 of the 11 sectors continue to slowly and steadily rise, but it's no fun. We want to see some more action too. So, but technically, if we can trend above those moving averages, they start to turn up. These are great signs that the market broadening strength continues.
All right, folks, now we get you caught up on some of the biggest stories we were watching at the street. First of all, thank you to Catherine and Jay for that there. Don't mind me, I was just tweeting. All right, today we have an earnings roundup. Let's kick things off with Nvidia. The chip maker impressed Wall Street with its fourth quarter earnings Wednesday, posting a slight beat on both earnings and revenue. While these figures are down from a year ago, Nvidia saw continued growth in its data center business, which develops chips for AI, giving investors hope that it could benefit from advances in AI software like ChatGPT. Never heard of it. But it's not just investors that are optimistic. Nvidia upped its sales outlook with expectations that annual revenues would rise 7.4% to $6.5 billion. The company's stock is up around 45% in 2023 alone. Next up, let's talk eBay. You've won the bid. While the company posted better than expected results in its fourth quarter, shares of the e-commerce giant are taking a hit on a muted sales outlook. The company declined to provide financial guidance for its first quarter, warning that weak consumer spending would likely eat into its sales and profits for the first half of the year. eBay also reported a decline in buyers in its fourth quarter, down nearly 10% from last year. Shares of eBay are down 17% over the last 52 weeks. And finally, let's talk Moderna. Shares of the drug maker are dropping sharply this morning after the company reported results well below the street's estimates. Moderna blamed the bleak quarter on rising costs and lower demand for its COVID vaccine, which notably is the company's only product on the market. While Moderna's sales have declined significantly, the company is currently in the process of developing a vaccine for RSV, which will likely receive FDA approval in the back half of this year. Shares of the company are down around 12% since the beginning of 2023. And that's going to do it, my friends, for The Street today. Thank you once again to our very special guest, Mr. Sam Stovall, Chief Investment Strategist at CFRA, for taking the time to join us this morning. Stick with TheStreet.com for more on these and all of the major market stories that matter to you, and we will see you tomorrow.